We're going to talk this week about a very important topic that, um, I think we all would like to do better at, but it can be kind of a challenge sometimes, how to sell more index universal life products. And then are there ways perhaps to offer those products to people that would appeal to more individuals and beyond just life insurance? And there certainly is. There are some people that want their life insurance to do a lot of heavy lifting for them. They've done maybe a lot of reading about it. Maybe they've seen some TikTok videos or something on social media that really helps them understand that index universal life products can be more than just life insurance. And so how do we position index universal life to those people? How do we even find those people? Well, one way to find those people is just by asking a simple question. What do you want your life insurance to accomplish for you? What do you want your life insurance to accomplish for you? Do you want it to have provide enough money to provide capital for the family to take care of themselves as they mourn your loss and figure out next steps? Do you want your life insurance to create generational wealth? Or do you want your life insurance to help you save for retirement? That question throws people off. They're like, save for retirement? I didn't know the life insurance can do that. Some people are aware of it, but some people aren't. But when you ask that question, those who are aware of how life insurance can be used that way, well, they know now that you know how to do that and that you're a good fit for them. Or people that have never thought of their life insurance that could do such a thing, that question has piqued their interest and they want to learn more. See, so it helps you separate the people from who just want life insurance to cover funeral and final expenses. It helps you find those individuals who want to use it to save for retirement. And those are typically going to be individuals who have a higher net worth, or if not that, a more of an expendable income that they can set aside for life insurance. Okay, so it's good to find those individuals. And life insurance can be just that, a tax retirement account. Some people call them TFRAs, others may call them 7702 plans. But whatever the case, they are a life insurance product. It's an index universal life product that has been structured in a way where less of the premium goes towards the face amount of the policy, but more of it goes towards the cash value accumulation of the policy. Okay, so that's good to know, to have that understanding there of how those policies work. Most people use status quo tools to save for retirement, such as pensions, 403Bs, 401Ks. Financial advisors love those products because they can park your money into a product like that and earn commission every year for your entire lifetime. And they can just sit back and collect the checks without having to do very little in return. So financial advisors love those tools. The more money they park, the more money they make. The federal government loves those tools because they create tax revenue. In fact, that's why the federal government required some years ago people to start paying required minimum distributions at age, let's say 73, because there were individuals who were living off of their Social Security and not their 401Ks. And then the government was not getting taxes on that money. So in order to trigger people to start paying taxes on that income, they put into effect a law that required people to start taking minimum distributions from those accounts at a certain age. And so the federal government loves these tools. You generate the money, and then they get to pay. You get to pay the taxes to them, and it's a win-win for the government from their perspective. So that's why 401Ks, 403Bs, and the like pensions are so important to financial advisors and the federal government. But the problem is those tools don't solve for two very important problems. Number one, taxes. Number two, market volatility. If you were to look at the tax code in a chart, taxes are at or near the lowest they have ever been. Now, if that is if every American was taxed the same. We know that's not true. That doesn't happen. But if every American was taxed the same, we'd be near the lowest tax-wise we've ever been in this country. The second low or the first lowest would have been probably around the Clinton administration. And so the current tax code was renewed last year, but it was originally set up and some modifications were made, some improvements were made but it was first set up during the Trump administration. And that would have been before the pandemic, before student loan forgiveness, before the war in Ukraine. And then the tax code was renewed. So what do you think is going to happen? You ask people, are taxes going up in the future? What do you think they're going to say? Well, they're going to say, yes, of course. Taxes, I expect them to go up and not stay the same. So that's the first problem that these retirement accounts don't solve for is taxes. Number two, they don't solve for market volatility. That's a key point, guys, because the stock market we know is volatile. Did you know it takes on average 6.5 years to recover from a market downturn? So that means, let's say that we'll use 2022 as an example, okay? We say that the market ended down about 20 points. Well, if I was in an indexed account like an indexed universal life or an indexed annuity, I would have lost nothing that year. I would have maybe uh, gotten zero growth or maybe 1/4 of 1%, but I would have gotten no growth. But that means I also would have gotten no decline in the account too. In 2023, let's say the market ended up about 24%. So that means that I made 4% over those 2 years. I made back the 20% I lost, and then I made 4% on top of that. That's an anomaly. It was an anomaly created by the pandemic, which doesn't happen every day. Typically, it takes 6.5 years to recover from market volatility. And so it's important for people to understand that about being in the market directly and in 401ks and the problems that they solve, but also the problems that they create. But a tax-free retirement account solves those two problems. A tax-free retirement account is set up as an index universal life policy. These tools are not unique. It's not like somebody decided one day, hey, I can market index universal life as tax-free retirement accounts. They've been around for decades and decades, and they're commonly used by the wealthy to avoid paying taxes on income. Companies use them as bonuses for their executives, and they have been for decades. Companies like GE, Bank of America, they do that because you can only put so much money into those 401ks and 403bs and the like. There's a limit as to what can be contributed, but with a tax retirement account, there's no limit to how much money you can put into them, and they are not subject to market volatility, and they're not subject to taxes. So you see why these things can be appealing to individuals who have come to understand that life insurance can do more than just provide a death benefit. So to help individuals then understand how these products work, or even if they would be a good fit for these products, I ask some questions of the client. I'm really performing a financial inventory is what I'm doing, okay? So this is one of the questions I ask. When you retire, do you want to maintain your current lifestyle, or are you happy to settle for less? What do you think the answer to that question is going to be? No one's going to say, I'm happy to settle for less. They want to maintain their current lifestyle. And it's quite possible they have not thought about the reality of that until you ask that question. People always want to maintain. Then I ask them a follow-up question. Has your financial advisor shown you what your income will be when you retire using your current retirement approach? Now, people will always say one of three things. I don't have an advisor, or no one has shown me anything, or my advisor has shown me what my income will be. I have yet to find somebody who will say, yes, my advisor has shown me what my income will be. It is usually um, the first two. I don't have an advisor, or no, he or she hasn't shown me anything. And that's where I start. This is where I start then really digging into the financial inventory. I ask them, what is your household income? Then I ask, what is your household budget? Now, if you don't make it weird, this is not going to be a weird question to answer. If you just ask these questions as if this is what you do all the time, and this is normal, and people always tell me this information, then people aren't going to hesitate. I don't need them to give me income down to the penny or budget down to the penny. What I'm trying to determine is what is their income and in general, what is their budget? Do they even have a budget? Whether they have a budget or not tells me something else too, because it'll tell me if I can expect a NSF report on a request for for money transfer or for banking request. If they have a budget, I'm likely not to have that problem. If they don't have a budget, then the risk is a little bit higher that someone's not going to be able to maintain a tax-free retirement account like they want. It sounds like a great idea to them, but they don't have maybe the discipline to do it. Okay, so that's why I asked those two questions first. What is your household income and what is your household budget? Then I ask a series of questions back to back. What is your current age? Even I don't ask what their date of birth is. I ask, what is your current age? What is your target retirement age? Do you want to be partially retired at this age or fully retired at this age? Are you married? Do you have any kids? Uh, what is your health condition like? If you're, we want to find out that they take any medications. Has the doctor diagnosed them with any conditions? If their age is below 55, then a TFRA is likely going to work for them. If they're over 55, they at least need to have probably 10 years to retirement. Okay, so I need to know this because these accounts, guys, need to accumulate cash value over time with compound interest. So I need to have enough years to do that. Um, if if I remember correctly, it was Albert Einstein that called compound interest the eighth wonder of the world. But it only works if there's enough time to accumulate compound interest. Uh, and I'm also trying to figure out if they even qualify for life insurance. See, that's the thing here too. If they're going to use tax retirement accounts and IULs at TFRA, they have to have the health to do it. And if they don't, then I'll have to pivot to writing them an annuity, where, like with National Life Group, for example, NLG, that will allow them to put money into it maybe on a monthly or quarterly or annual basis. Some companies have a minimum for their annuities of like $10,000 for a transfer. And so I need to put maybe they don't have 10,000 a month to contribute. Not many do. And maybe they've got 400 or 200 or 300. Well, I need to find somebody like NLG to steer them towards. So that's why I'm asking these questions. Do you take any medications? Has the doctor diagnosed you with any conditions? What's your living situation? Do you rent or own? What tools are you using to save for retirement? Such as, are you using an IRA? Are you using a 401k, a Roth, a savings account? Do you have any money saved outside of your retirement account? What types of products are you using? It tells me a lot about a person when they have just a regular savings account at their bank or their local credit union versus a high yield savings account that they found online. See, if they're using a high yield savings account with like Capital One or what have you, or some online bank, that tells me they're a little more educated than the average person. They're trying to find a higher return on the money that they're saving. How much are you currently saving? That's key. How much are you currently setting aside every month? And are you disciplined at it? Are you able to contribute that amount every month, or do you get behind some months? When it comes to their retirement account or 401k, IRA, whatever the case they're using, TSP, I ask them, does your employer match your contribution? Now, that's a very important question, guys. Does your employer match your contribution? You want to find out what percentage are they contributing and what percentage does their company match. Now you understand why it is I asked what their annual income is. Because they may not know the amount they're setting aside, but they may know the percentage they're setting aside. So I can do the quick math right there. Let's say they're making $100,000 a year and they're contributing 4%. Well, I can do the calculation on my phone, and now I know how much they're setting aside. Then I ask them, how much does your company match? Well, they match up to 50%, up to 2%. Okay. With that information, I know that what they're doing is they're taking 2% of their income and they are contributing it towards a product that is going to increase their tax liability in the future, when instead I can just change the column that this money is going to right over to a IUL. And I have not increased their budget. I have simply changed the column for which that money is being, where it's being spent, from the 401k to a TFRA. I'm just moving it over. I'm not trying to find new money in their budget. I'm just taking the money they're already spending and just moving it to a different column, into something that is a tax-free retirement account. So that's why I asked them, what is your income? Then I asked them, is this amount your income alone? Or is it, the combined household income? That's important. And you find out, is this your income alone? Does this income include more than one income stream? So do they have a side hustle that they're working at? See, I'm getting now a more complete picture of what it is they're actually contributing, where it's going. Do you think your income is going to increase in coming years? For many people, they'll say yes, because they know that they've got certain bonuses or certain times of the year where their performance is reviewed. And if they pass, they get a bump in their income after the next performance review. So that's an important question to ask. Do you think your income will increase? What is your plan for that increased income? Now I'm getting into a series of questions that help me understand if we can put together a number for them that they can maintain. All right. What are your liabilities? In other words, how much is your mortgage, loans, credit, groceries, insurance? I mean, what monthly number do you need to make your expenses? And what I'm trying to find is the amount of money they need versus the amount of money they get paid, to see, are they living way above their income, or are they living well below their income? What's the range in there? And people sometimes don't think about what that range is. Let's say I find out that they've got $4,000 of expendable income every month. Okay. Um, where is that $4,000 going every month? When you ask people that question, for many people, that's the first time they've ever thought of that. That's a good question. Where does that $4,000 go every month? And they're beginning to realize all the money they spend on TV subscriptions and Starbucks and all these things that are, it's just money just flushed down the toilet with nothing to show for. And they begin to realize, hey, I can reallocate this money in another category where I actually have something to show for it. But see, you're helping them think this way without actually even saying it. You're just asking them some questions about their liabilities. I try to get very specific amounts too, as specific as I can without making it awkward. Is there anything else you're planning financially on your road to retirement? Like taking care of college for your kids, and taking care of aged parents, contributing to a charity. With all that information, guys, I'm able to schedule now a second meeting with the client to review the answers to their questions, and they will often remember additional details before the next appointment. And with that additional information, I'm able now to make sure if the proposal I put together is going to be a good fit, or if I need to adapt it. This is where it is key to make sure you know how to write illustrations. Now, I'm not saying you need to learn how to write illustrations before you start doing this. I didn't, but you eventually will need to learn how to write illustrations. And the reason why is the proposal that you go into the house with, or you call the client about to review together, that you email to them over the telephone, you're going to talk about this, it may not be valid with information that they remember when you come back. So you may need to just go into like the F&G portal to the illustration and make some adjustments to it right there on the spot to make sure you have a real proposal to show them, to explain to them. And that's why it's important to learn how to write illustrations. Initially, like when I sell a lot of F&G products myself, and I've been writing more and more with the Nexus. They're nationwide and North American products for different reasons. But when it came to F&G and IULs, I was writing almost all my IULs with little exception with F&G. And I would call F&G's pre-sale support number, and I'd ask them, hey, This client's got $500 a month to spend on an index universal life product that I want to structure as a taxable retirement account. Can you create the illustration for me? And they will. They'll send it over to them and then over to you. And then you can call them back and say, hey, can you show me how you created this illustration? You have the illustration they created with you, and now they're going to log into the portal and they're going to show you how they created that illustration. That is fantastic information because now you can compare and you can learn. And by doing that a few times, you're going to be able to just correct an illustration on the fly in the client's home. If you don't learn how to do that, the problem you run into is that you may have to come back with a more accurate illustration later, and you run the risk then of losing the client's interest when you have to come back repeatedly before the illustration is correct. Okay, so it's important to ask the carrier how to write this illustration, why they write it the way they do, and then learn how to do it yourself. An index universal life product, guys, is a very powerful tool. It's not just used for life insurance, although that's probably the main way many people use it. But it's a very powerful tool that provides not only life insurance, but cash value that follows an index like the S&P 500. And you can write more of these if you have confidence. What's the old saying, fake it till you make it? Um, when I first started writing life insurance, I remember something that Bell Kraus said on the platform, a family reunion, that was probably the most powerful thing I learned when I first started writing life insurance. You're going to make mistakes. Even after years of experience, you're still going to find yourself making a mistake on an application or illustration that you need to correct. It's not the end of the world like you may feel it is. It's something that can actually very easily be solved. But if you're afraid of making mistakes and you let that hold you back from starting, well, you'll never get started. So be confident in yourself. If you learn how to get a life insurance license and pass the test to do that, you can sell index universal life policies. And there may be a learning curve, but you'll figure it out. But if you never get started, you'll never figure it out. Right? So it's important to have confidence in yourself. Okay, you can do this if you want to do this. I also remember something else I've learned in this whole process too. If I'm not learning new things, I'm scared, because what that means is that I have capped out my income earning potential. It's going to be capped out at term and final expense, or it's going to be capped out at term, final expense, and index universal life. I don't want that to happen to me. I want to I don't want to leave money on the table. You see what I'm saying? I want to make sure that I can write index universal life policies designed the way a client wants, but whether it be for life insurance or retirement or education or just saving for a house, whatever the case. I want to be able to learn how to write annuities, because that's where the big money's at, right? That is in annuities. I want to learn how to manage assets. I want to learn how to do seminars for estate planning. I want to learn all these new things, because when I learn them, there may be a year or two learning curve before I feel like I'm really have mastered this technique. But what will happen to my income in the process? It's going to grow incrementally. There are a couple of books I encourage you to get. You can find them on the Alliance uh, bookstore or store. I think it's called Alliance Store, in fact. And there are actually three paperback books there. Two of them are for $10, one's for $3 or $4. One's called Save Smarter, Not Harder. The other one's called Safe Money. And there's another one you'll find. I can't remember the name of it off the top of my head right now, but you'll find it if you just scroll through. You'll find the book on there. It's like a 92-page book for $4. Get those books, guys. Read them over and over again so they fall apart. Make notes in the margins, underline things. When they fall apart, get new ones. They're only $10. So get new ones, read them again, digest them, read them over and over and over and over again. And what you're going to find is those tools will help you understand how index universal life and annuities work. And you'll understand it so well, you'll be able to explain it to other people with very simple phrasing. You won't be talking over them. You'll be able to explain in very simple ways why these tools are to their advantage. And when you can do that, then you can say you have truly mastered a topic, when you can teach it easily to other people. Well, I hope this was helpful to everyone today. I enjoyed hosting the Monday message. Best wishes out there to Holly and Stephen. You know, Holly's going through a minor procedure, or maybe not so minor, but she's going through a procedure, and she's recovering, I'm told, very nicely. So we wish the best for her and for Stephen both, and for little Tinsley. We love all of them, and I know you guys love them and wish the best for them too. And so Steve will be back next week for the Monday message. Until then, guys, have a great week, and blessings to you all.